Welcome, it's the Crypto Sniper, guys. How are you? This will definitely be the final Crypto Sniper video of the year, but I just thought I'd follow up yesterday with something that you can watch. 5 key traditional market indicators that will forewarn if and when Bitcoin and crypto as a whole are likely to have a sell-off. So we've kind of created a bit of a theme. By the way, that super tight stop that I put on that was run almost instantly. We've had a bit of chop at that neckline level. I can just show you that Bitcoin chart to follow on from where we left off. You can see that there's quite a bit of channel grinding over here. There was quite a bit of volatility on the run of this key level. That indicates it probably is a key level. We tend to have multiple entries, and I tend to show the most aggressive for the R's. But without a doubt, that's most aggressive option did indeed break. I'm showing you a new one with, again, the localized high. It may survive, it may not. But let's get on with the video rather than get too in the weeds of the short-term price behavior. It's very easy to get tricked in on that. You get a bit of news. Oh, Michael Saylor bought another 2,000 odd Bitcoin. Way, run, charge up. Actually, by the way, by the time these announcements are made, it's usually because he's done buying. So he's been buying, and that was actually quite a small amount by previous standards. So it usually means he's done buying for that spell. He may re-enter, but I think there's normally a period before. By the time they make an announcement, it's in retrospect. But the market at a retail level often gets re-reminded of this buyer that's out there and gets a little bullish. It can introduce a bit of volatility. You get a run up and then you get a run down. So just as a top tip for future, bit like share announcements, XYZ director has finished buying some shares in his company and is waiting up because he likes the prospects. You're told in retrospect. In short, everything that was going before was when that was happened. Let's get into number one on the key traditional indicators, traditional market indicators that will be very relevant for whether Bitcoin is going to be strong, flattish, moderate, or out and out weak. And we've been watching these, and they put us on that red alert state where we are warning. Remember, this doesn't mean it's tomorrow, the next day, the next 5 minutes, the next 15 minutes, and it doesn't mean we've called the end of the bull market. It means we potentially see a sell-off that could go substantially down. I also want to, before I go into that number one, make everybody aware that previously, to get the run up to 64,000 that we had on Bitcoin, and just pivot to the weekly chart, we actually first had a washout for the events of CV19. So that was over here. Let's log scale it because it was some time ago now. But you'll see it here. We traded almost as high as 14. We were kind of sideways. We got a little bit of weakness that occurred over here. And then we are kind of easing, dripping, rallying just before you were north of 10K and you got run down first, push the ball under the water. That displaces a bunch of water, hold it unnaturally down, and then you get the pop to the upside. Then all the QE came, and then it was up, and to the races. So often, before a real big new number, 108 is not huge at the moment relative to 69. It's clear that there's still potential for greater upside in Bitcoin. You may first need the washout to the downside to do that. Many might be asking, was the period between March and November sufficient enough of a washout? Of course, we had the Japanese yen moment that was 70K to 49. It was pretty significant, but it was about 20K and about 70K. So, it's not huge, as opposed to at some point being 10K and above and going all the way down to 4. That was a 60% decimation, while 20K clearly is not to the same degree. Okay, so let's get into that number one indicator in the traditional markets that could point to problems coming for Bitcoin. And this is why, in actual fact, on the short time frame view, we've actually got that little rally, in my opinion. The rates have come down here. You can see in the last day, we had quite a pullback on the rates and we've gapped down over here. What are we looking at? We are looking at the government bonds US 10-year yield. And what does that actually indicate? It's a falling wedge in our opinion, this structure, and it is something where the rates are going a lot higher in our view. We expect the 5% to be run again and potentially for a blow off and a surge well through that. This break actually came earlier than even we forecast, and we're the most bullish on yield, which is the most bearish on the valuation of debt. So debt deflates, the more the yield required goes up. People are bidding lower values and wanting a higher yield as a result of paying less and wanting more interest in. That is a devaluation. And one of the key things that I say on the Market Sniper channel, don't forget to subscribe. People continue to tell me that they are being unsubscribed and de-notified. Hit the always button on the bell, is that it's about the debt. This whole story is about a debt-based collapse, and that's why watching one of the core central long-term debt market instruments is one of the most important things you can do. Technically, we're in this falling wedge. We had these three localized highs that we've got over here. We had already pinpointed the first two and said we expect it to come back up and make this other third high, and thereafter we expected rates to ease. In fact, we suppositioned on possibilities of a far deeper dip in rates than we ended up getting. The rates turned quite promptly and they started to go straight through our red line, which means rates going up, debt devaluation accelerating. Now that's not good for your retail housing market. It's not good for the job market. It's not good for anything finance. It's not good for your subprime cars. In the real world, all these things are big, big issues. Further to which, thanks to Yellen's approach, Granny Yoda Yellen, who has been moving all of America's over expenditure to their tax revenues, debt onto far shorter time frames, a large amount of that is coming to be rolled over in 2025, 7 trillion. It is one of the biggest histograms of rolling debt that needs to be refinanced during the course of the forthcoming year. That means apart from the government's already over expenditure, you get about 52% tax revenue and you spend 100, so it's almost twice what you're getting in that the government is spending. That is your inflation. Milton Friedman's definition, government expenditure beyond receipts is absolutely inflation. Devaluation of currency, of course, lots of it going to Ukraine and Israel and handing out Christmas presents to thugs, but that's how it works, and that's your politics of your world today. So this tenure moving higher towards the 5% level is very dangerous, and this is why we've had the weakness in Bitcoin with that big sell-off during the spell, and it's also why with a bit of a pressure taken off that you've had a little bit of holding the line and not going down anymore. So in the last day or two, the rates move went against our expectations. It's not going to go up in a straight line. We expect it to go up, but in staircase as usual with continuation. But during these pullbacks, you should get support for Bitcoin and crypto and many other risk-on type assets, but particularly sensitive is the crypto markets. So the contraction and the collapse of the debt market, the acceleration thereof is driving dollar strength. Why is it hurting Bitcoin? Because as rates get higher in America, other nations' money, sell euros, sell pounds, sell yen, sell Korean won, we'll come back to that one in a bit, sell their currencies and put their money in an American bank account and earn the higher yield that the market is offering. So the debt collapse of America actually sees the dollar climb. They are on a seesaw. They're on a seesaw. So you get a dollar dominant spike during these periods. That's very destructive to countries that have borrowed in dollars, and that could lead to a contagion. Watch out for that later on, but that's on the bigger macro timeframes. So The dollar dominance comes as a result of yield-based activity in the price discovery market of the 10-year, not what the Fed has done. I want to highlight, if you watch one of our last Market Sniper videos, that in actual fact, while the Fed since September has cut 100 basis points, this 10-year since September has actually gone up 100 basis points in the opposite direction to the Fed. In short, the market makes the interest rates long run. And if the Federal Reserve is wanting the bond market to be stronger and is cutting rates and not delivering the yield, they'll find out that they'll be the only buyer in town, and the market will move away from them. And that's kind of what's happening, a divergence of opinion. So this is one of the most important indicators for dollar strength. And I'll be talking more about the dollar strength when we look at some FX pairs, but the real driver is the debt markets. Okay. Number two, in our traditional market indicators for whether the crypto market and Bitcoin market are going to have a good time, we're going to stay in the yield and debt market space. The difference between long-term debt and shorter-term debt, 2 years. This is what we were saying, Yellen stacked too much on the shorter-term side because the rate was a little bit lower. Generally, rates are higher for the longer you borrow. There's greater risk. There's more time for things to go wrong, etc., etc. Now, inside of this, we've had one of the largest inversions, yield curve inversions ever. The modern era, certainly. There have been periods where they've gone deeper or been a little bit longer pre-1980s. But if you look at the 1980s, below the blue line over here is a yield curve inversion. That is a 100% indicator of a crisis. It has shown itself many times. There's the subprime one. There was the dot-com one. There was a very small touch for the CV19 events. And here was a far larger, deeper, longer one that has just reverted positive. It breaks, it return moves often. So we called it when it broke. And of course, the return move comes. Everybody goes, you're wrong. Remember, don't be short-termist about this. Things can break, return move, and it can take a while. We're on a monthly time frame, and you'll probably note that you had 1, 2, 3 candles in there before you've reverted back strongly. The crisis comes as you revert back above the zero with momentum. You will see this is 2007. The real pain came in 08 and 09. This is the 2001. The 2002 recession came following that. We're on a big time frame chart. As these revert violently positive, you are looking at a substantial crisis. This is a 100% indicator, guys. It is not a shot. It's not a possibility. It's deeply, very deeply in the high probabilities. It's never not been. So far it's hit, 6 out of 6. So to bet against it is harsh. And we are in this strong reversion back positive move where the yields required on the longer term debt are climbing far faster than that on the shorter debt, and we're getting a steepening back up of the yield curve as you go further out on the longer time frame. So those are the two debt-based indicators. Number one, the 10-year itself, is the yield going up. Number two, the relative strength of the 10-year to the shorter time frame rates. This is the one minus the other. The 10-year less the 2-year. Yield curve reversion is leading to this acceleration to the upside. Okay, let's get to number 3 in terms of what's happening. You should see examples of this in dollar strength. And what happens when you have dollar strength is things like gold and silver don't sell for as much because the dollar is stronger relatively. And when the dollar is strong, it's considered more of a reserve asset. You can earn interest on it. Gold and silver doesn't pay interest. So what you tend to get is a weakening or a benign stale period in gold and silver. Remember, gold ran first before Bitcoin. Gold is the king of the anti-fiats. By the way, on that key point, while we're covering point number 3, if you hit the link below and subscribe for our mini course, you will receive our newsletter. And in our newsletter, we have given you the anti-fiat structure, who is the king of the anti-fiats, how it all breaks down, how we and why we frame in this manner, and you will find out that gold moves first typically, and it did. And it broke from 2000, and later we got the unleashing of Bitcoin. Now gold has actually been slowing down, and silver has been slowing down too, even more so. So the chart you're currently looking at is in fact the gold-silver ratio. The gold-silver ratio. And for this to become very bullish for precious metals, we actually need this chart to go downhill. What's actually happening is it's going up and it's breaking out of a technical pattern over here, and it is going up. So the gold-silver relative relationship, how many silver ounces you need to buy a single gold ounce, is actually climbing and has broken out of a technical pattern. What would be very good is if this broke down through the 75 down to the 65. This points to a typical risk-offing type vibe. And a dollar dominance type period. It's another point that is indicating that we could get some serious dollar schizophrenic strength. Not, oh, the economy is awesome, everybody's doing so well, strength. No, the debt market is collapsing, interest rates are surging in an uncontrolled manner. They're going to cause lots of hardship in real estate markets and everything else, and internationally for those that have borrowed in dollar terms. So as a result of all of this, you're going to see the gold-silver ratio also start moving higher. That is pushing out the next leg of the gold bull and is pushing further out when you get the super overperformance of silver. It's likely too that this will affect crypto, Bitcoin and crypto. So as a result, dollar strength, interest rate strength, gold and silver stepping back and no longer being dominant upside runners. So gold-silver ratio is your third take on our indicators in the traditional market that things could get tougher for crypto. To be kept up to date on these traditional market indicators that can be very, very useful when they're meeting key moments, you're welcome to get our newsletter through that link below as described, and you will see charts like this as well. By the way, we cover crypto specifically too in these. These are free updates in our newsletter. So we've covered so far in the 10-year interest rates going up is strong for the dollar, is damaging for crypto. The yield curve accelerating, meaning the difference between long-term debt and short-term debt getting ever larger, is also a quickening and bad for crypto, strength potentially for the dollar. We've also highlighted the gold going sideways or a little bit off and down, not making new highs anymore, and silver slipping relative to gold in terms of the gold-silver ratio is again not good for crypto and likely to point to dollar strength. So what is the fourth indicator? Well, I'm going to take you to a specific currency pair. This particular currency pair should actually look like an even bigger version of our call that we made on XRP when it spiked really hard and fast. And we are expecting a similar disorderly market with a halvening of the USD Korean won. This is our particularly selected Asian weakest currency going into 2025, and a 30-year pattern almost has triggered. So the last major move was in and around 95 all the way through to, and we're going into 25. That is a 30-year setup with very powerful up legs, long, lengthy, calming legs that take a long, long time. We've had a bit of a rounded bottom finishing here, and then we've got our third high with pullback there. These kind of structures, which have massive spikes and are disorderly, and I want to highlight that during the Asian crisis, you can see that you had huge patches of gaps there and very disorderly overperformance spikes. The target actually on the previous smaller HVF, which is kind of like the 2017 XRP. I will show these back to back, by the way, so that you can see the technical similarities. We'll highlight how this move, you got chronic overperformance to that target. Why? Disorderly, panicking markets. disorderly, panicking markets. And it's our expectation that you're going to run at least to a point where you get a doubling of the amount of Korean won you will get for that $1 at minimum. And this triggered properly for the very first time during the course of December month. This is another indicator of dollar strength against probably one of the most compromised of the first world FX currencies. This is not the South African rand or the Turkish lira. It's not even the Indian rupee, which, while a big economy, is a very flawed currency. We're talking about, the home of Samsung, Hyundai, Kia, etc. It's a first world nation, and we're expecting an outlier event that will be part and parcel of both dollar strength and Korean-based weakness. So a very powerful trade, but when this moves in its fast periods, this will be typically due to A, Korean-based events, and B, likelihood of very strong dollar dominance periods. This particular chart moving strongly up is going to be very bad, and the fact that this 30 years triggered is pointing to, I feel, a form of reset-based debt challenge that is not too far away. With that baked in, the progress of this chart is going to be negative for Bitcoin. In fact, it serves as a great hedge for Bitcoin going down, because you could make profits on the dollar strength against a compromised won into 2025, 26, and any blow-off events like this would likely be quite detrimental on crypto and pullbacks on gold and silver. However, you would be profiting to the upside with this form of trade. It's a 30-year gestation. This is the longest gestation I've ever had, and it had a beautiful wind-up just before it. And as I've highlighted before, it's almost the grandfather of the XRP. Let's have a look at the XRP version of it so that you can see technically how the two are very similar. Let me just turn some of my analysis off and you can see it again. We were on the monthly time frame and we spanned 30 years there. You can see the similarities here with a major wind up here, subsequent setup again, and you can see this move. The Korean won is awaiting that major surge in the same way as you received for the XRP trade. These are very, very similar, although totally different markets by nature and far longer in standing. The longer the pattern, the longer the duration, the greater the squeeze, the bigger the eventual move. So we would see a disorderly events, and this is our fourth indicator as to why we feel that you will start to see clear evidence of challenge in the crypto markets, Bitcoin and the rest of the alts, when this chart is progressing even further. Let's give you one other anti-dollar, just because we don't want to end on 4. Odd numbers are good, 3, 5, etc. We've done a lot of work in the soft markets. The softs have been running. It's been illustrating inflation. These are super, super high. However, this or something like oil are typically likely to sell off. So cocoa is the charts, by the way. You can take a soft agricultural like cocoa or coffee, or even look at the WTI oil. If you are going to have a dominant dollar, and this leans on, it's more a confirmation of the same theme, because the debt will drive, the spike in interest rates will drive the 10-year, which will also drive the yield curve inversion. So there's a lot of overlap in this. It will also drive the dollar dominance, which will see the USD Korean won move, and it's likely to make softs come down. Now remember, the softs are facing inflation. You've got cocoa, you've got coffee that have had excellent years to the upside, terrible for the cost at the point of sale for you. However, we've just had that initial stab back that was part and parcel of the warning that dollar dominance is coming, and also the retail consumer might get a little bit crushed, so there'll be less buying and dollar stronger. Let's put a little bit of a rain back on this. You are currently getting a rally, but I wonder if we haven't had a little bit of that strength checked in much the same way as Bitcoin broke the neckline and has had a rally back. But is that the full story? Are we going to get a little bit more pullback? So bearish on oil or the likes of the key soft markets, cocoa, Robusta or Arabica beans, are another manifestation of a risk-off environment that will be indicative that crypto could actually be coming off. And most of this is driven by strengthening dollar, which is being driven by increasing rates. Okay, so 5 different charts that will give different representations of a core underlying theme so that you know that crypto could be running into trouble. Have a smashing new year. Thanks for the support on the channel during this period. We appreciate you and we really look forward to having it. Hit the like. Don't forget, if you wish to book a call to take your trading further, hit the link, book a call. We only take calls from people that have gone via the website. We will never DM you. We will never ask for investment money. Please be aware of those things. And we clean all our comments from scammers after all the videos to try and maintain a nice orderly environment for you to interact with that. Okay, catch you later. Enjoy the new year proceedings. Much blessings from the Sniper team. Bye for now.
Tired of profit wipeouts and blown accounts from following trade signal groups and other YouTube channels? Looking for a better way to trade, reduce your stress, and minimize your risk? Become a skilled technical analyst and see the charts and markets in a new light using the successfully proven HVF method by Francis Hunt, while being surrounded and supported by a principled, structured, and experienced community. Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser and app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately, strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time and with focused effort, you'll begin to look at charts and price action just like Francis. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. We've changed thousands of traders' lives. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.